Hi, my name is Nazril, and in this roleplay, I will be playing as the company executive.
Hi, my name is Sophia and I will be playing as first financial analyst.
Hi, my name is Aisha Nabiha and in this roleplay I will be playing as a second financial analyst.
Hello, my name is Anis Shafia and I play two characters in this roleplay, which is lead financial analyst and the third financial analyst.
Hi, my name is Roala Alina Hafiz. In this roleplay, I will be playing as the last financial analyst.
Assalamualaikum, good morning everyone. Are you guys doing fine today?
Good morning, we are doing fine. Thank you for asking.
Alright, so you guys may sit now. So Anis, what is the purpose of our discussion today?
Our purpose for our discussion today, we want to determine the ratio analysis and we want to determine the most suitable short-term financing for our company.
Okay, so what has been shown as screen right now is the statement of financial position and the statement of profit and loss of MTD Berhad for the year 2021 and 2022. Okay, without further ado, let's move on to our business. As everyone is informed, today's objective is to analyze and compare the financial report of our company. So you guys can start now.
Okay, first of all, I want to introduce our financial analyst. Let's start with Aglan. She will present about liquidity ratio, and Aisha will present about leverage ratio, and I will present about activity ratio, and finally Alia will present about profitability ratio.
Okay, I get it now. So for financial ratios, there are 4 financial ratios that have to be addressed today, which is liquidity ratio, activity ratio, leverage ratio, and profitability ratio. So do you guys have any questions that have to be addressed?
Okay, so may I request information of total current asset, total current liabilities and inventories of 2021?
Of course, based on the data, current asset is 413 million, current liabilities is 300 million, and inventory is 33 million.
Okay, I got it. Okay, so next may I request same information but in 2022?
Of course, the current asset for 2022 is 332 million, the current liabilities is 336 million, and inventories is 39 million.
Okay.
So for my ratio, which is leverage ratio, may I request data for total asset, total liabilities, earning before interest and tax, and interest expense for the year 2021?
Yes, of course. The total liability is 1.036 billion. The total assets is 1.745 billion. The earning before interest and tax is 47,500, and interest expense is 24,776 ringgit.
So what about the year 2022?
Okay, so for the year 2022, the total liability is 1.009 billion. The total asset is 1.665 billion. The earning before interest and tax is 39,504, while the last data is interest expense, which is 23,878.
Alright, may I ask you about the current value for cost of goods sold and inventory for 2021?
Yes, of course. The cost of goods sold for 2021 is 238,110,000, while the inventory is 33 million. Aside from that, is there any more information that you need?
Yes, I want to know about the value of account receivable and credit sales.
Okay, so for the value of accounts receivable, it is 75 million, while the credit sales is 511,582,000.
Alright, for 2022, may I know what the value is?
Okay, so the data for 2022 are: the account receivable is 78 million, the credit sales is 640,372,000, the inventory is 39 million, and the last one is cost of goods sold, which is 390,177,000.
Alright, I get it. Can I request the data so I can calculate the profitability ratio?
Of course, what are the data that you need?
I need earning after tax, sales, and total assets for 2021.
Okay, so the earning after tax for 2021 is 55,347. The sales are 511,582. And lastly, the total assets are 1.745 billion.
What about 2022?
Okay, so for 2022, the earning after tax, sales and total assets are 18,742, 614,372 and 1.665 billion respectively.
Let's start with Adia first.
Okay, thank you, Miss Anis. Okay, so this is the figure which is our company liquidity ratio. So in 2021, our current ratio is 1.38 times. Meanwhile, in 2022, our current ratio is 1.99 times. So this proves that our company in 2022 is unable to pay its short-term obligation. Meanwhile, in quick ratio, in 2021 is 1.3 times, and meanwhile in 2022 is 1.88 times. So this is also the same reaction, which is our company is also unable to pay its short-term obligation.
Thank you, Dia. I understand our situation now. Honestly, I'm a little worried about our company because currently both our quick ratio and current ratio is getting worse than previously. But it's okay, you guys can continue with the leverage ratio.
Thank you. Now I will be presenting leverage ratio. Thank you, Ms. Adia, for your explanation. So I will continue with the leverage ratio as you can see from the slide. Based on the graph, the debt ratio for the year 2021 is 59.37%. Meanwhile, for the year 2022, the debt ratio is 60.60%. This shows that the debt ratio for the year 2022 is worse than the year 2021. This is because our company has more debt financing for the year 2022 compared to the year 2021. Now, moving on to time interest earned. For the year 2021, the time interest earned is 1.92 times. Meanwhile, for the year 2022, the time interest earned is 1.65 times. This shows that for the year 2022, the time interest earned is worse than the year 2021. This is because our company has less ability to pay its interest obligation for the year 2022 compared to the year 2021.
Okay, thank you Aisyah for the explanation. Honestly, I am a little unhappy about our leverage ratio and I hope we can do better about that. Anyway, you guys may continue to the next ratio.
Thank you. Next, I will be the one who presenting about activity ratio. Alright, for activity ratio, as you can see in the bar chart, our value for inventory turnover for 2021 is 7.23 times. Meanwhile, for 2022 is 8.18 times. This shows that our company is better. This is because our company are more efficient than previous year to generate more sales and utilizing the inventories. Alright, moving on to average collection period ratio. As you can see, from 2021 to 2022, the value had decreased from 52.78 days to 45.71 days. This shows that our company is better. This is because the firm capable of collecting its debt than in the previous year.
Okay, thank you Fia for your explanation. Based on the data presented, I am very satisfied of our company ratio. So next we can move on to our next ratio, which is the profitability ratio.
Alright, thank you. Now I will explain about profitability ratio. Based on net profit margin, it indicates the amount 3.57% had decreased to 1.048%. This shows the company is getting worse. Also, the company is less efficient in generating more returns and profits from its operation. Next, return on asset in 2022 is 0.71%, too low for every 1 ringgit of investment in the firm's equity compared with 2021. This shows the company is also getting worse and is less efficient in generating higher profits from its assets. Our company is also still under review for financial this year.
Okay, thank you Adia for your explanation. To be honest, I am also a little dissatisfied about our profitability ratio. But let's conclude our discussion and move on to our next objective. Okay, so other than our financial ratio, I am also a bit worried about the performance of our current business situation. In order to prevent this problem, I think we need to have a deep discussion about our short-term financing. Our company need to raise 500,000 ringgit in order to support our working capital requirement for 6 months. Can you give me some alternative that we can take?
Yes, there are 4 alternatives that we can take from short-term financing.
Okay, so first, we can apply for a loan from Bank Islam that pay an interest rate of 6% on a discounted basis. The bank only requires a 15% compensating balance, but our company also need to maintain a demand deposit of RM50,000 ringgit in the bank. Through this alternative, the earning interest rate that we have to pay is only 6.52%. So discounted loans refer to a loans offered at a reduced interest rate or a rate lower than the standard market rate. So the discounted loan also could be a promotional offer by the banks or a financial institution aiming to attract borrowers by providing an initial period of lower interest rates. So there is a pros and cons of discounted loans, which is discounted loans provide flexibility in both usage and repayment terms. So this flexibility allows our company to utilize the fund for business expansion. Other than that, discounted loans also typically involve offering loans at an interest rate lower than the prevailing market rate. Moreover, risk tolerance in discounted loans refers to the level of risk that our company is willing to accept when investing in loans. Higher risk discounted loans typically offer returns but come with increased chances of default or non-payment by the borrower. And discounted loan also often requires collateral as security for the lender, and the collateral serves as a form of guarantee that the lender can seize and sell if the borrower defaults on the loans.
So for alternative 2, the effective interest rate is 50.24%. So our company has revolving credit agreement with Maybank for the total amount for 570,000. So in this alternative, we use straight loan alternative. Straight loan usually provides with a fixed interest rate, meaning that the interest rate remains constant through the entire long term. In addition, based on the condition, Maybank charge commitment fees for the unused loan. This indicates that larger portion we have to make a payment goes toward interest. Straight loans generally have fewer options of modification, so borrower may find it challenging to renegotiate terms. For example, extend the loan period or make other adjustments to the loan structure So when this occurs, it can limit the flexibility in terms of usage and payment. Next, if our company has stable income, payment can be made consistently. If by result, it may be difficult for our company to cope with the risk. And yes, for this alternative, it will require collateral if our company fails to make a payment on the due date.
For alternative 3, effective interest rate is 58.22%. Generally, commercial paper with longer terms tends to have higher interest rates compared to short-term commercial paper due to uncertainties that may arise over an extended period. So for second, short-term commercial paper offers greater flexibility as it allows the company to access funds quickly and repay obligation within a relatively short period. If we apply commercial paper, our company borrowing costs will tend to rise because commercial paper provide a higher interest rate. So the commercial paper needs to be rolled over or refinanced. Therefore, the risk tolerance of our company should consider the potential impact of interest rate fluctuation on the cost of borrowing through commercial papers. And lastly, commercial papers doesn't require specific collateral to secure the loan.
For the last alternative, we can propose a 3-year deal with a favorable term of 4/10/40. After doing some calculation, the effective interest rate is 50%. So, 3 Trade credit is a business-to-business agreement in which a customer can purchase goods without paying cash upfront and paying the supplier at a later scheduled rate. Now, the pros and cons of trade credit are: first, trade credit does not involve interest rate. Second, for flexibility in terms of payment terms, we can negotiate flexible payment terms, including the length of the credit period. Meanwhile, for usage flexibility, trade credit flexibility can involve accommodating customized orders based on the buyer's specific requirements. This will help to build a more tailored and collaborative relationship between the buyer and the seller. Third, trade credit does not require collateral, as it is a form of credit extended between businesses in the course of their normal commercial activities. And the last, for trade credit risk management, we can manage trade credit risk through self-insurance and outsourcing debt collection.
Thank you everyone for the insightful comment and opinion. Anis, can you tell me which one of the four alternatives are the best?
Yes, after we evaluated all the four alternatives, the most suitable alternative for our company is discounted loan, as it offers the lowest effective interest rate among the four alternatives, which means it has the lowest cost of getting working capital.
Thank you, Anis.
May I take this opportunity to summarize our discussion?
Yes.
Okay, so the operation of our company, which is MTD Berhad, lies in the plantation division. We have a deep root expertise in farm oil, certification and processing. Based on previous year, our ratio has been worse. In order to prevent this problem, we have to raise additional capital using discounted loan. So in conclusion, to overcome this difficulty, we must improve our financial situation.
Alright. Thank you everyone. As we have met all of our objectives for today's meeting, you all may dismiss.
Thank you.